All right, let's get started with tonight's presentation. And as you just heard, tonight's webinar is being recorded. So if you would like a copy of what we cover this evening, feel free to reach out to me by email. I just put my email in the chat and I'll be more than happy to send you a copy, or anyone that you know, family or friends, a copy of tonight's presentation, Building Wealth with Real Estate. We're going to cover a lot tonight on how you can really take advantage of the cascading effect of building massive amounts of wealth through real estate. And you can do it with a lot less money than you might think. I know many people who have become millionaires and multimillionaires starting out with $25,000 or less. Some of them starting out with near $0, depending on the type of financing that they use. So with that, let's get into tonight's presentation by starting out with what we'll be covering this evening. We're going to talk a little bit about taxes, because taxes play a role in all things you do financial, especially with your investments. We'll cover tonight the different ways that real estate is taxed and the advantages of getting cash through monthly rental payments versus getting cash out of your property in various other ways that we'll discuss. After all, you might have seen that tonight we're going to talk about how you can cash flow over $100,000 and not pay any taxes on it. We'll also go through a couple of case study examples, real world examples on how clients I know, people I've worked with, have made hundreds of thousands, if not millions of dollars tax free. And then we'll close it out by talking a little bit about real estate depreciation and how that can also create cash flow for you. And we'll also go over what depreciation is for those of you who might not be familiar with it. And then I'll close it out before Q&A, talking a little bit about San Diego. If you have any questions about the real estate market in general or the San Diego real estate market, feel free to put those in the chat. And again, we'll answer those at the end. And we're also doing another webinar in 2 weeks that's going to do a deep dive into the state of the real estate market with an update on both national and local San Diego real estate statistics. With that, I also want to kind of start out by saying you really should have a qualified CPA if you're going to get into real estate, even as just a homeowner. Certainly as an investor. I know taxes really well. I read the tax law for fun, and I used to be a teaching assistant at UCLA for a business and real estate taxation course. So as much as I understand the tax code, I personally still hire a CPA to help me with my taxes. So depending on your situation, I certainly recommend that you work with a CPA for any and all of your specific tax questions. With that, quick background on myself, and then we'll get into nuts and bolts of tonight's presentation. My name is Patrick Kappel. I am the team leader of the Kappel Realty Group, one of the top leading San Diego real estate teams at Compass, and certainly one of the top teams in the nation as well. I have a little over 15 years of experience in the real estate market. My wife and I own a total of 8 properties, many of them multifamily, such as duplexes and fourplexes here in San Diego. I've been a board member of the Southern California Apartment Association for a number of years now, over half a decade. And with the team that I manage, Kappel Realty Group, we have sold collectively nearly $500 million in San Diego real estate in just the last 5 years. That's composed of over 750 units. So what does that mean? That means my team and I, we know what we're doing. We know what's going on in the real estate market, and you don't get to $500 million in sales by not understanding real estate. So I really am looking forward to educating you today on what I've done for many of our clients, what I've seen our clients do as far as building wealth through real estate. You see the education there in the center. I went to the University of San Diego, where I earned a Master of Science degree in real estate. I have an MBA with a focus in finance and real estate from UCLA. And at the bottom there, you see the U.S. Naval Academy is where I earned my bachelor's degree. And it's this educational background that my team and I approach real estate brokerage with. As you might find and expect, a lot of real estate agents and brokers are kind of salesy, and we approach this business from an educational perspective, which hopefully you'll get tonight. The awards there, you see quite a few, and that's just a handful of them. But every year we've been a team now for quite some time, over half a decade. We have consistently been ranked in the top 1% of teams nationally and locally here in San Diego. So at the end of tonight's presentation, in about 55 minutes, if you do decide that you want to buy real estate or invest in it, even if it's just your first home or your 10th property, the best way to get a hold of me is email. You see it at the top there, patrick.kappel@compass.com, and I'd be happy to send you a copy of tonight's presentation, a few other webinars, and meet with you to assist you with your real estate goals. Knowledge is power. We all know that. That's a first key to getting into real estate. And I like this quote that comes from Robert Kiyosaki, the author, many of you might know, of the book Rich Dad, Poor Dad. And this quote is that it's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. So what's he saying when he says it's not how much money you make, it's how much money you keep? He's talking about taxes there. And Robert Kiyosaki is saying at the end of the day, you can make millions of dollars, but if most of it goes away in taxes, what's it all worth to you? And that you should find tax advantaged ways to build wealth and invest. Real estate has some people might call them loopholes. I call them the tax code. The real estate industry and real estate investments have far more loopholes than you'll find in compared to most other investments that there are available to your common investor. So let's start out with this example. Would you rather make $20,000 per year for 5 years, every single year, $20,000, and be taxed at 32% a year? Now, as you add that up, $20,000 a year over 5 years, that's $100,000. But every year you make that money, you're taxed at 32%. Or would you rather make $0 for those first 4 years? And then on year 5, you make $100,000 and it's taxed at 0%. Well, unless you absolutely need that $20,000 year over year to pay for your living needs, then the answer is probably pretty clear. And you want to go with the second option. Get $100,000 at year 5, taxed at 0%, because that way you get to keep all 100,000. If you're taking 20,000 year over year for 5 years, taxed at 32%, you don't end up with 100,000. In fact, you end up with 68,000, because a large portion, almost a third, goes to Uncle Sam, the tax man. So most people looking at this question would prefer to take option 2. $100,000 all at the end, tax-free. What blows my mind and should be intriguing to you is that when you rephrase this question and you ask people, would you rather invest in real estate that pays you high monthly cash flow, taxed at 32%, but low appreciation? Or would you rather invest in real estate that gives you low or almost no monthly cash flow, but it appreciates a lot and you can tap into that and pay no taxes on it? Which would you rather pick? For some reason unknown to me, most Americans will say they'd rather have the high cash flow when it's phrased as real estate, not realizing that they are giving up significant amounts of their return in the form of taxes. This is why when I began investing in real estate, I created the strategy of investing for appreciation, knowing that the tax law will make you much wealthier if you invest for appreciation versus cash flow. And some people say appreciation is speculative. I would argue it's not. If you understand economics and you understand real estate, you'll be able to target markets and properties where appreciation is almost all but assured due to macroeconomics of that market. What I would say is speculative is rents, your monthly cash flow, because you are no longer betting on just on the macroeconomics. You're betting on one human being that you barely know paying you rent every month. For this reason, I'm an investor of appreciation. Many of my clients have done the same and become millionaires by doing so. So let's talk about why it is that you lose so much money to Uncle Sam if you invest for cash flow versus why you're able to keep that money if you invest for appreciation. You see, at the end of the day, Uncle Sam loves the monthly rent checks you get. He's going to dig into those with his claws. but Uncle Sam will stay away from your appreciation of real estate. Can't say that about all assets. If you have a stock portfolio, if you have a retirement account or a 401k, in that account that you invest in stocks appreciates, when you pull the money out, you will get taxed. But there's ways to avoid taxation when you get appreciation through things like real estate. And I'm telling you, real estate is a special little gem in the US tax code that gets special treatment that no other investment gets. So, real estate cash flow, let's define that for a moment, because so often people mistakenly think that the only form of cash flow in real estate investing is that monthly check that you get from your tenants every month. And that's just not true. Real estate cash flow, by definition, is a liquidity event. What do I mean by that? It's an event that causes your investment to give you cash flow. Now, an easy to think of liquidity event, yes, is your monthly rents that you get from your tenants. But there's multiple other liquidity events that can be attributed to real estate investments. So let's go through each one of them. And importantly, let's talk about how each is taxed. We already talked about the first one, monthly rent. The next one is a sale of a property. We all know you could own a property for a year, 5 years, 10 years. It appreciates, it goes up in value, you gain equity, and eventually you sell it. That, by definition, is a liquidity event, the same way renting a property and getting rents is a liquidity event. You get cash put into your pocket. It's just what I would call delayed gratification. The next liquidity event is a 1031 exchange. Later in the presentation tonight, we'll deep dive into what a 1031 exchange, how it works. But in layman's terms, in 5 seconds or less, it's selling one property and using the proceeds to buy another property. We also call it a trade up. We also got cash out refinances. We'll talk about those a little bit later. We'll do a deep dive on an example. But a cash out refinance is putting new financing, a new mortgage on your property in order to pull some cash out of the equity you've accrued. So let's talk about how each of these are taxed. Now, for the monthly rental checks you get from your tenants, that is taxed at the highest tax rate in America, also known as short-term capital gains, also known as ordinary income. And that, for most people, is going to be around 32%. For some people, it's less. For some people, it's more. But when we look at the majority of Americans, you pay about 32% plus or minus of your monthly rents to the tax man. Now, let's say you sell a property. Your tax rate is going to be between 0% to 15%. For some people, it might be as high as 20%, where you make a huge gain on that sale. And we'll talk about that in a little bit. But it's certainly going to be close to zero, at zero, or at least around half of what you get from the taxes you pay on your monthly rents. 1031 exchange is tax-free all day long. You don't pay any taxes on any of the gains on the sale of a property. In cash out refinance, number 4, I saved the best for last because it's my favorite. A cash out refinance gives you money in your pocket, hundreds of thousands, millions of dollars, money can come at you, tax-free. So when you look at these 4 ways that you can make money on real estate investment, which way would you prefer? Now, what if I told you, to make it easier, that all of these ways on property X, Y, and Z would make you the same amount of money? Let's say monthly rents could make you $100,000, a property sale could make you $100,000, 1031 exchange and a cash out refi can make you $100,000. If you know that they can make you about the same amount of money, which one would you invest in? And the answer is clear. You invest in the one that pays, that taxes you at the lowest tax rate, preferably has a 0% tax rate. Now you might be saying, well, Patrick, not all properties are going to pay the same return. Yes and no. All properties throughout the United States, due to things like liquidity risk and just risk compared to the 10-year treasury, which is known as risk-free rate, American real estate pays about the same return no matter where you buy it, East Coast, West Coast, Midwest. It's going to have different cap rates. It's going to have different appreciation rates, but your cap rate plus your appreciation rate equals something called the Gordon growth model, a model used in finance, used in stocks, and also used in real estate. And your cap rate, for those of you who understand investments, plus your appreciation is going to equal about 9% plus or minus 1. So no matter what you're invested in, the question isn't what kind of a return do you want? You're going to get about a 9% return plus or minus no matter where you invest in the US on multifamily real estate. You're going to juice those returns by using leverage, using debt, a mortgage to buy a property. So the question isn't how much of a return do you want? It's how much taxes do you want to pay the tax man? As a person who doesn't like who wants to pay as little in taxes as possible, I appreciate investing for appreciation versus those monthly checks that come through rents. So, as I mentioned before, most people work and invest for ordinary income. Why do most people do that knowing that's the highest tax rate? It's because most people, as you can imagine, don't understand the tax code that well. The tax code is very complex. I don't know half of the tax code, but I certainly understand the portions of the tax code that have to do with real estate. As you saw in my bio, I have a master's degree in real estate and I have an MBA with a focus in finance. So I certainly understand taxes in real estate. And that is why I decided to do, and many of my clients do, what the wealthy do, and that is build a fortune through means of long-term capital gains, not ordinary income. So what is the difference between ordinary income and capital gains, long-term capital gains? And what are the wealthy doing? What do they know that everybody else is kind of oblivious to? Well, it's taxes. The way you make your money determines how it's taxed. Some people jokingly say America has two tax codes, one for the poor and the middle class and one for the wealthy. And the truth is that's not a real joke. We really do have two tax codes. We have a tax code based on how you make your money. And again, most poor Americans and most middle-class Americans, even upper middle-class Americans, just don't understand the tax code, and they make money in the most unintelligent way. And they make investment returns in the worst ways, while the wealthy focus on how can I make money without being taxed. One last example, then we'll get into some specific numbers of the tax code and how it affects real estate. This is stuff you should know even if you're not investing in real estate. And we'll go back to like, what would you rather be type of question. Person A, for every $100 person A earns, they are taxed at 0%. For every $100 person B earns, they're taxed at 32%. You'd rather be person A, right? And the question is, they both make the same amount of money over a lifetime. Who will end up wealthier with time? The answer is very clear, and we can see it here in the next chart depicted on this graph. I'm showing you this chart because I really want to put in perspective how important and how impactful taking taxes into consideration on your investments can change your ultimate outcome 10, 20, 30 years down the line. Now, they always say, don't let the tail wag the dog. Don't let taxes drive all your investment decisions, but realize the tail is connected to the dog. And inside of, with taxes being about a third of your income, it's a pretty significant part. So you need to take taxes into consideration when making investments if you want to make the most of the dollars you invest. So the chart in front of you shows what happens over a period of 30 years to $100,000 that grows at 8%, one of them in a taxable account and one in a tax-free account. You can see the blue graph is the taxable account, the orange graph is tax-free account, and $100,000 grows to only $489,000 over 30 years, growing at 8%. That same $100,000 grows to over $1 million over the course of 30 years. So you can see the person in this case who took tax consideration into their strategy ended up 2 times wealthier after 30 years compared to the person who did not take taxes into consideration. For this reason, now add a zero to that $100,000. Add a zero to everything here, because as we know, real estate is usually bigger money. It's easy to be, not easy to, but it's very common for a real estate buyer in San Diego to buy $1 million property, not a $100,000 property. That $1 million property growing at 8% could become $10 million in 30 years. Now, 8% is a pretty high rate of appreciation, but we are up there around 6% in San Diego. So when we compare ordinary income versus long-term capital gain type of income, what falls under each tier? Well, ordinary income, as I would like to remind you, is the tax, the way to make money that gets taxed at the highest rate. Again, this is the way most middle-class people focus on making their money, because they want instant gratification. Most people want instant gratification. It's human nature. It's not good nature, but it's human nature. So what gets taxed at the highest tax rate? Ordinary income. Money that you earn from work and from your job. Now, I'm not saying go quit your job. Of course, don't. Keep your job, and hopefully you make more and more money every year. But just be aware, I think you already knew this, your W-2 job or 1099, if that's what you work in, is taxed as ordinary income, highest tax rate in America, 10 to 37%. There's other forms of income and investment income that are also taxed at this exceptionally high tax rate. That is money you don't make through a job, but you make through investment. First one, cash flow from dividends. Let's say you own a company, and a lot of you own companies. You don't think about it, but if you have a stock portfolio, if you have a retirement account, a 401k, a 403b, an IRA, and you're invested in the S&P 500, you own some companies, small fractions of them, and they pay you dividends every year. Now, if those are held in retirement accounts, you're good. You're not paying taxes right now. You will, though, eventually when you pull the money out. But if you just hold normal stock holdings and you receive dividends, well, you're getting taxed at ordinary income tax rates because you earn the money that year. And then let's get to real estate, the third one. What else is taxed at ordinary income tax rate? Rental cash flow from investment real estate. So if you own investment real estate and you're getting these big monthly checks, that's great. You're getting monthly checks. I hope it's at least covering the mortgage. But be aware that you are paying ordinary income tax rates. So when a client comes to me and they say, hey, Patrick, my number one goal in real estate investment is cash flow, cash flow, cash flow. It tells me right away that person either A, doesn't want to build maximum wealth, which is not likely, or B, they just don't understand the tax code. And that's where we come in to start training them to say, look, if your goal is to build maximum wealth, cash flow is great. I got it. But you know what's even better? Long-term capital appreciation. Why is that? Because you're going to get taxed at 0%, at the very most 20%. So long-term capital appreciation is capital gain in certain investments, like a stock going up in value, not the dividend paying out, but it's just going up in value, a business you own going up in value. And in the terms of real estate, the appreciation of real estate. So anyone who ever says, I don't invest in real estate for appreciation, I invest for cash flow, that individual either just doesn't understand the tax code or again is investing for the wrong reasons. I'm not knocking cash flow, the monthly rents. It's great. All I'm saying is appreciation is better because the way it's taxed, or more importantly, the way it's not taxed. So let's get down into the nitty-gritty numbers of how your income and your real estate investments are taxed or not taxed. I've got on the left here, we just got done with our 2022 tax season. So let's take a look at what tax rates we all paid. On the left, you can see the tax brackets for a single person. And on the right, you can see the tax brackets for married folks that are filing jointly. Now, under each category, single or married, there's two different tax tables. Why is that? Because as we mentioned, the United States has two different tax systems. One for those who make money off short-term capital gains, and another tax system for those who make money off long-term capital gains. Or as you might commonly hear, A tax system for the wealthy and a tax system for everybody else. Now, the wealthy play on the right. They play on the long-term capital gains tax rate because they know the tax rates are so much lower there. When you invest in real estate, you get to consciously choose. Are you going to invest for cash flow? Are you going to invest for appreciation? And it's going to determine where you get taxed on this table. So let's zoom in on one of these tables. And for example, we're zooming in on the married filing jointly tax brackets. As I highlighted in red, most Americans operate in the tax table on the left, short-term capital gains. Now, when you make money through a job, your W-2, your employment, your paychecks are getting taxed at this tax rate, 10%, 12%, 22, 24, then 30s, you get to 32, 35%. Now, a lot of people aren't going to clear over $340,000 through their job. So most people are paying 12 to 22% in income taxes. Now, if you buy and own investment real estate, the cash flow you get from monthly rents is going to get added on to your income from your job. Could push you into a higher tax bracket. And you certainly can see here that you're going to be paying at least 20 some, if not 30 some % of your rents and taxes. For those who invest for appreciation, however, you see over here on the far right that you can make up to $83,000 in appreciation and you don't get taxed a penny. Whereas on the left, if you're making 83,000, you're getting taxed at 12% already. Then if we look again on the right, with real estate that you invest in for appreciation, you can make over $500,000, $517,000 to be exact, and you only pay 15%. 15% tax bracket up to $500,000, whereas on the left-hand side, if you're making $500,000, you're being taxed at 35%, over 2 times higher the tax rate. And then we see on the far right again that if you make over $500,000, over $517 million on capital appreciation through something like real estate, you're capped out at 20%. So what does this mean? It means you can make millions and millions and millions of dollars in capital appreciation, and you'll never pay more than this 20% here. Whereas on the left, if you're making your money through cash flow, you're paying 37% already. So why is this important to know? Because you can see 15% is half of 30-some %. You can see how your net worth can grow exponentially faster and more throughout time when you're making investment decisions that focus on investing for capital appreciation. Well, you might be thinking, Patrick, this is great, this is cool, but I know you need some cash flow. Well, when you're young, and by that I mean like in your 20s, your 30s, maybe even your 40s, your cash flow to pay your bills, your food, your groceries, your mortgage, your car bill, your gas, that should come from your job. Your investments should be your investments. Your job should pay your bills. And what do I mean when I say that? Your investments aren't there to pay your monthly bills. Your investments are there to make you wealthy. And if you're investing in things, stocks or real estate, or you name it, to become wealthy, you should invest those that are going to in things that'll grow tax-free. Your cash flow from anything such as real estate doesn't really need to kick in until you truly do retire and you don't work that day job anymore. That's when maybe you want the rents, the monthly cash flow to kick in. But I'm going to show you some ways where you can get much more cash flow than what you get for a monthly rent and pay no taxes on it. Because how do we do this? Well, there's an infinite amount of ways to make money through long-term capital gains on a somewhat regular basis and have them taxed at 0%, especially if you get started young enough. So how do you reduce and, or more importantly, eliminate taxes altogether from your investments? Well, there's 4 primary ways. One is the owner exclusion. You occupy the property 2 out of the last 5 years. The second is a cash out refinance, also known as harvesting the asset, just like a farmer would harvest a field. The 1031 exchange and the step-up cost basis. Now we're going to dive deep into each one of these and explain each one individually. And if you have any questions as I go through these, feel free again to type them into the chat. But I always like to really harken back to Ben Franklin. Ben Franklin is attributed with a quote that there's two things certain in life: death and taxes. However, Ben Franklin did not live in 2023. Maybe back when he was alive, taxes were a certainty. But in the United States that we live in today, those two things are no longer both certain. Death is pretty certain, but taxes are not certain. There are ways to make millions and millions of dollars in America without paying any taxes on it throughout your entire lifetime, legally, not the Al Capone way, legally, and to leave the millions of dollars to your children and they don't pay any taxes on it. And it all has to do with real estate, specifically real estate appreciation. So let's talk about that. We'll start out first with the 2 out of the 5 year rule. This applies to almost every American that owns a house in our country. Now, if you own or occupy a property and you've lived in it 2 of the last 5 years, if you're single, you do not get taxed on the first $250,000 in gain upon the sale. If you're married, you don't get taxed on the first $500,000. So let's put that into an example. Let's say you buy a condo for $500,000, you and your spouse, first place. You live in it for 10, 15 years, and now it's worth $1 million. It's literally doubled. And that's not surprising because in San Diego, historically, our real estate values appreciate at a level that allow them to double in value about every 15 years. So about every 15 years, real estate in San Diego doubles. So you bought it for 500,000, it's worth $1 million. You sell it, you made $500,000 and you don't pay any taxes on it. Anything above that amount, you pay the long-term capital gains rates that we already went over, 0%, 15%, 20%. So again, this applies to almost anyone who owns a house. You have to have lived in it 2 out of the last 5 years. You don't have to have lived in it 5 years. You don't have to have lived in it 3 years. You just have to have lived in it for at least 2 years, and it has to be 2 of the last 5. So if you lived in it for 2 years and then you move out for 4 years, well, you haven't lived in it 2 of the last 5. Now you've only lived in it 1 of the last 5 because you moved out. So this is good to know if you ever do want to sell a property, you move out of it, convert it to a rental. I would recommend selling it within 36 months, within 3 years, so you can get this big tax write-off. We've helped a lot of our clients make hundreds of thousands of dollars tax-free with this very easy, simple strategy. The next one, this is my favorite, cash out refinance. I've got a mantra that I live and die by, and that is buy real estate, never sell it. My wife and I, over the last 15, 20 years, as you mentioned, we've purchased 8 properties, millions of dollars worth that keeps on appreciating, and we've never sold any of it. We just do this strategy, cash out refinance. So let me explain it through a very simple model that you see on your screen. Let's say, again, you've got that same condo. It's worth $500,000. Your mortgage balance, though, is $300,000 because you've been living in it for 10 years. You've been paying down your mortgage, paying the principal down. The property's been appreciating, and now it's worth $500,000. Well, you do what's called a cash out refinance. This allows you to get money out of your property without having to sell it and without doing a HELOC. What do you do? Well, in this example, we get a brand new loan for $400,000. The new $400,000 loan pays off the old $300,000 loan. And what's 400,000 minus 300,000? 100,000, of course. That is the extra money that goes to you. That cash goes to you tax free. You pay no taxes on that money, and you can do whatever you want with it. Now, most people would use that money to go buy more real estate, to go invest in something else, to keep on growing their wealth. That's what I would do. But if you want to use that money to send your kids to college, use that money to go on a nice vacation, buy a car, you name it. The first time I did this, guys, I had a property that had appreciated significantly enough that I was able to do a cash out refinance and pull out like $300,000. And I'll never forget the way I felt when I had a check handed to me for over $300,000, over a year's salary, easy, and I didn't have to pay any taxes on it. It is so amazing when you can get this money tax-free because you intelligently invested in something like San Diego real estate that appreciates. Now let's go to the next example, 1031 exchange, another great way to get money out of your property without paying taxes on it. In this example, let's say you buy a condo. Let's say you buy it for like $300,000 and you own it for 5 to 10 years. It starts appreciating, you're paying down your mortgage, property goes up more in value, and it gets to worth, say, 500,000. Well, you sell that condo and you use the proceeds you've gained over a couple $100,000 in appreciation. You gain your proceeds to go buy another property. So you sell the condo, you buy a duplex. Now you buy $1 million duplex. You own that for 5 to 10 years. It appreciates in value. You're paying down your mortgage, and you sell your duplex and you use your sales proceeds, your gains, to buy a triplex. You own that for 10 years. It goes up in value. You sell it, use the proceeds to buy a fourplex, and so on and so forth, and you buy a fiveplex. So now here you are sitting at like 90 years old. You've lived a good long life, and you started out by buying a little condo, and now you're sitting on a $2.5 million apartment building. And oh, by the way, you could have bought that condo for as little as 5% down. That's how little you need to buy real estate with a conventional loan. If you're a veteran, you can buy it with 0%. You can also use 3.5% FHA. But let's say you buy this $500,000 condo, 5% down. You bought it for only $25,000. And over the course of your lifetime, you turn it into $2.5 million without having to put any more significant money of your own into the property. That's how you build real wealth. And oh, by the way, all those gains are not being taxed. And you can do this 1031 exchange as many times as you want, no limit. You can do cash out refis as many times as you want, no limit. Well, you might be thinking, this is cool, Patrick. Well, what's the end game? Well, the end game is this. Remember, I said you're 90 years old. You got this $2.5 million building, been appreciating, 1031 exchanging. You started out with a $500,000 condo. When you die, you leave your assets to your children or charity, your spouse, whoever you want to leave it to. In this case, let's say you leave it to your kids. A lot of times people tell me they want something to leave to their children. So you leave them a $2.5 million apartment building. You just made your kids multimillionaires overnight. Now, if you would have sold this building the day before you die, you are going to get taxed on all the gains between 500,000 and 2.5 million. So $2 million. At least it's a long-term capital gains tax. However, here's how you don't pay taxes. If you don't sell the building during your life, in that last building, the fiveplex at the very end of your life, you leave it to your children. Your children can sell it and not pay any taxes. How does that work? It's called a step-up cost basis. The IRS is a funny organization, and the tax code, guys, it doesn't always make sense. But if you understand the tax code, you can make it make you millions and tax-free. So it's written into the tax code that if you own some real estate and then you croak, you die, and you leave your real estate to your kids, the value of it gets step up. What does that mean, step up? Well, remember, if you sold it, you bought it for $500K at the beginning years ago, sell for $2.5 million. So you're getting taxed on $2 million in a gain. If your kids buy it, the basis for you is 500,000, but the basis for the property they inherited is $2.5 million. The IRS, for lack of better words, pretends that your children bought it for the value it was the day you die. So your kid's going to get this $2.5 million property, and your child's going to sell it. They're going to go to your funeral first, pay you respect. And then after that, they're going to sell that multifamily property, and they're going to get $2.5 million tax-free. They don't have to pay any taxes on it. That is how you pass generational wealth onto your children. You cannot do that with your retirement accounts. You cannot do it with your IRAs. You cannot do that with your 401ks. If you leave a 401k to your child, it wasn't taxed your whole life, but when your child starts pulling money out of the 401k, it will be taxed at ordinary income tax rate. highest tax rate in America. This is why, my friends, real estate is a far better investment than any other investment in America, including your best structured tax deferred retirement accounts. This is better than a 401k because you're leaving all that wealth to your children tax free. Now you might be thinking, because I know what you're thinking, I'm just like you. You might be thinking, because I all the questions you have, the thoughts you have, I wasn't born knowing this stuff. I had all the same questions you had. And then I went and found the answers. And the question I had, and you probably have, is, well, this is great, but you want to enjoy your life. Sure, you're going to die in your 90s, but what about your 50s, your 60s, your 70s, your 80s? You want to travel the world. You want to go on a cruise. You want to buy a vacation home. You want to enjoy your years. And how are you going to enjoy the years if all this money's tied up in this property? It's cool that it's growing tax-free. It's awesome you can leave it to your kids tax-free, but you want to enjoy a little bit of it? Well, that is where the cash out refinance comes into play. You see, all of these years, probably decades, all of these years, you are doing cash out refis. You will let a property appreciate. You'll sell it. You'll take the proceeds tax-free, go buy something else bigger and better, something that will appreciate even more. And a year or two after that 1031, you harvest that new asset by pulling cash out with a cash out refi. A couple of years later, you 1031 that, you go buy something else, harvest the asset, do the cash out refi. So this is combining the two strategies to ensure that you are benefiting financially and very clearly through this massive cash flow coming out of your property through cash out refis, tax-free, and you're building the wealth, the appreciation, tax-free. And when you die one day, which we all will, you leave it to your children, a huge multi-million-dollar asset that they inherit and can sell tax-free. That is the beauty of the tax code, guys. And there is no reason that anyone in America shouldn't be able to die a multi-millionaire and be able to enjoy the majority of that money through things like cash out refis throughout their life. So let's get into a couple of real world case studies. Let's see how this really gets put into practice. I got, I think, 3 case studies, maybe 4 to share with you. The first, a duplex in North Park on Georgia Street. One of my friends purchased this actually back in 2014. He was able to buy it for $726,000. He used a VA loan, by the way. So he bought this with 0% down, no money out of his own pocket. Now, 6 years later, he sold it for 1.021. He gained almost $300,000 tax-free. He took that money and he was able to get it tax-free because he did a 1031 exchange, which implied he bought another property of equal or greater value with the proceeds of the first sale. Well, he took that $295,000 and made it a down payment on the purchase of this fourplex you see at the bottom of your screen, 1484-90 15th Street in Imperial Beach. Now, with that fourplex, he had it appraised just a couple of years after buying it for $1.55 million. First of all, we got a heck of a good deal on it. Second of all, 2020 was a great time to buy real estate. A lot of people were running for the hills. Good time to buy real estate. So he made over $500,000. When you add it all up over an 8-year period, he grew $0. Because remember, he bought the duplex with a VA loan, 0 money down. He grew $0 into over $800,000 tax-free, all because he was doing what other people are afraid to do. He was out there making decisions, making moves, buying real estate. And he can turn that equity, $800,000, into cash flow, real money in his pocket through things like a cash out refinance, which wouldn't be taxed at all, or a sale of the fourplex, which would be taxed at the lowest tax rate, long-term capital gain. The next example is also down in IB, just coincidentally. It's a triplex. It was purchased by a couple of my team's clients that we were assisting in 2020. Now, these were 2 young officers in the Navy. Because of my military background, I've been in 23 years in the reserves and active duty. We work with a lot of military clients. So these 2 young Navy officers, all of their friends, all of their family told them not to buy real estate because it was 2020. And they thought, you know, we got this pandemic going on, lots of bad stuff happening. Who knows what's going to happen tomorrow? Their friends and their family told them not to buy real estate. Here's my advice to you. If your friends and your family are multimillionaires in real estate, take their advice when it comes to real estate. If your friends and your family are not multimillionaires when it comes to real estate, then you probably shouldn't take their advice when it comes to real estate and look at folks who have truly succeeded in it. I don't give advice on things I don't understand. My wife's a nurse. I know nothing about medicine. So I don't give any advice when it comes to medical advice. People, though, are so happy to offer their unsolicited free advice. Stop listening to it unless they have degrees and or in-depth experience in it. So we convince these two young guys, don't listen to your family, don't listen to your friends. Listen to them about all kinds of other things, relationship advice, etc., not real estate advice. My team and I know what we're doing. Let's go buy some real estate, guys. So they bought this triplex for $890,000. It was cash flowing $0 because they also understood the appreciation play that we had educated them on. Cash flowing $0. Mom and dad said, don't do it. We convinced them to otherwise, because trust me, one or two people not buying real estate is not going to change my life, but I knew it would change their life. And how did it? Well, we helped them sell this property just over 1 year later in 2021 for $1.3 million. These two young guys in their early 20s made over $400,000 in a capital gain. They didn't 1031 exchange. They didn't do a cash out refi. They were moving on to other things. They just want to take the money, but at least that nearly $500,000 they made was taxed at the lower capital gains tax rate of 15% instead of 32%, the ordinary income tax rate. I'm going to share with you one more case study, a real world example. And I know this one really well because this is me. I bought this house that you're looking at in the photos on the right when I was in my late 20s. I bought this actually 2012. I would have been in my early 30s, actually. I would have been 31 years old. It was my third purchase. I had already bought 2 condos. I was serving in the Navy, and I was married to a nurse. And I highlight that because I want to show that it's not a secret to really building wealth in real estate. Here's a guy that was in the Navy, me, and my wife, a nurse, kind of middle-class people, making large amounts of money by making the right decisions. Now, when I bought this home in 2012, I bought it for $695,000. Most of my friends and all of my family, they were saying, you shouldn't buy this. It's foolish to buy. My mom and dad, they were mad at me for buying this house because it's 2012. There's a big recession going on. They thought a $695,000 house, like who would pay that much for a house? It was in Point Loma. And I saw the value in it. I saw the direction the economy was going to go. So my wife and I, we were renting at the time, $2,000 a month. And we stopped renting to buy this house with a mortgage of $4,500 a month. And we only moved like 5 blocks. This is why my friends thought I was crazy, because they're like, man, why would you trade in $2,000 a month in rent for $4,500 mortgage? You're over doubling it. But I saw the value. I listened to my mentors who were 20, 30, 40 years older than I am at the time, and they were giving me the same advice I'm giving you. They said, buy real estate, never sell it. Certainly don't rent. Just buy and hold on to it, let appreciation do its thing. So let's look at how just this one home can turn a person into a millionaire. In 2015, market keeps going up. Things are looking better. We had this property appraised at 1.1 million. We did a cash out refinance. I kind of taught you already how cash out refinance works. We pulled out $400,000. And with that money, we did a $400,000 renovation. So you can see the outcome of that cash out refi. The property looks a little better. The kitchen on the right, the top one looks like the 1980s or 90s. The bottom one looks much more modern. Then some years go by, it's 2017. We now had it appraised at 1.6 million. Why did it go up so much in value? Because we just did a $400,000 renovation on it and a couple of years went by. So we had a lot more equity in the property. We did another cash out refinance. Again, I'm pulling all this money out tax-free. We pulled out $300,000 and we used that as a down payment to buy a duplex in Linda Vista. You see a photo of it here on the right, both the left and the right unit. Beautiful duplex, 3-bed, 1-bath each units. And we're getting good rents on it that are helping pay the mortgage, you name it. So in 2020, the property value goes up to $2 million. Again, this is the same property that we bought in 2012. So what do you think we did? We did another cash out refinance, pulled out about another $300,000, and we bought a fourplex near the beach in IB on Date Avenue, 234 Date. So as you can see through this one property that a young guy in the Navy and my wife, a nurse, bought, we, over a period of nearly 10 years, were able to pull out $1 million, 400,000, 300, 300, all tax free. I don't know where else you're going to make $1 million. One, by not working for it, and two, getting it tax free. This is how you truly build wealth, by owning real estate. And as you can see, I took all of our cash out refis and I reinvested it back into more real estate, either through a renovation of the first house, the purchase of a duplex, or the purchase of a fourplex. Now you might be wondering, Patrick, didn't your monthly mortgage payment go up a lot because I'm doing all these refinances, my mortgage balance is going up? Of course it did. My mortgage payment went up. However, the increase in the mortgage payment was offset by the rents I started getting from the duplex, the rents I started getting from the fourplex. And oh, by the way, about 6 months ago, my wife and I ultimately moved out of this house, 1018 Bangor Street. We turned it into a rental property. Our mortgage on that is around $6,000, and we're getting about $7,000 a month in rent now. So even with all these cash out refinances, pulling out $1 million tax free, we're renting it today with that higher mortgage balance, and we're still cash flowing $1,000 a month. That's just the power of real estate, the power of appreciation, and it compounding on itself over time, and the power of you having the knowledge to know how to intelligently access this cash. So back to the title of tonight's webinar: how do you pull out how do you make $100,000 a year tax free? Well, here you go. 2012 to here we are, 2022. We pulled out $1 million over those 10 years. We did it all tax free. You do the math, that's $100,000 a year tax free. Takes us back to our first analogy. Would you rather be person A or person B? We're getting close to the end, so I'll do Q&A, but right before Q&A, I want to quickly talk about depreciation for a few minutes. For those of you who are not familiar with the term depreciation, let's do a little quick one-on-one education on it. Depreciation is the decrease in value of an asset and the method used to reallocate or write down the cost of a tangible asset, such as equipment, or in this case, real estate, over its usable lifespan. Businesses depreciate for accounting and tax purposes. So what are we really talking about here? You know that most things in life, like a car, goes down in value after you drive it off a lot. You also know that real estate is one of the very few things in life that goes up in value. Just as much as real estate goes up in value, and just as much as a house or a building can last 100+ years, the IRS, remember, the IRS is kind of weird. It's kind of magical. It's got a lot of made up rules. And if you know the rules of the IRS, you can win. If you don't know the rules, you're probably going to lose. But one of the rules of the IRS is they pretend a building will only last for 27.5 years. So if we build a fourplex or you buy a duplex, does that mean the building's going to fall down in 27.5 years? Absolutely not. But the IRS is really nice to real estate investors. And it lets real estate investors pretend the building is not going to exist in 27.5 years. So you get to write off the cost of the building over 27.5 years. Are you really losing that money? Absolutely not. But they let you write it off as a tax deduction. So what do I mean? Best way to explain it is, again, a real world chart. This chart shows you a depreciation schedule for 234 Date Avenue, the fourplex I just showed you in IB, that big brown building. Well, when I bought it for $1.3 million, they said $500,000 is the land, $800,000 is the building. You can't write off the cost of land. You can't depreciate that, but you can write off the cost of the building. So we take $800,000 and we divide it by 27.5 years. Now the first year is prorated because I bought it around June. But if you divide $800,000 by 27.5 and you prorate the first year, you end up with about a $29,000 tax deduction every year. Now, am I really losing $29,000 a year? Not at all. Remember, it's IRS, it's made up, it's pretend, it's fantasy land. IRS rules are all kind of weird. The IRS is pretending I lose $29,000. The IRS is letting me pretend I lose $29,000, but the value of the building is not going down. In fact, it's going up. And I was actually making money every month on this property from all my rents and whatnot. So depreciation is just that, letting you depreciate the cost of a building over time. Now, the cool thing is you can also do a cost segregation study, which allows you to break up the building into different aspects of it. Because some things you depreciate faster than 27.5 years, like landscaping, sidewalks, electrical wiring, appliances. You can depreciate 5, 7, 15 years. The cost segregation study, you can accelerate some of the $800,000 write-off. For this property, we did a cost segregation study. You see it on the right. And $154,000 of the $800,000 was allocated to things that you can depreciate in 5 years. Things like landscaping. 15-year property was allocated to $46,000. The rest was allocated $599 to 27.5 year. So the year I purchased this property, I got $154,000 plus a $46,000 plus this $11,800 tax write-off. On year one, I got a $212,000 tax deduction. Now, did the building go down in $212,000? Absolutely not. Did I lose that money? Absolutely not. But I get this made up accounting tax deduction. And at the beginning of the presentation, I said another form of cash flow is tax deductions, being able to keep cash that is not flowing to the IRS, but instead is staying in your pocket because of things like depreciation. And for my purposes, you can see here a $212,000 tax deduction equivalent for me was like putting $84,000 in my pocket. Now you might be wondering, why does it say 197? Because that's the additional write-off I got because I did the cost segregation study versus if I just straight line depreciated it over 27.5 years. So this additional tax write-off of 197,000 is like $84,000 cash flow into my pocket because that's now 197,000 I'm not paying taxes on. Based on my tax bracket, it's $84,000 I'm keeping in my pocket that I wouldn't have otherwise. Again, tax-free. I could teach a 6-hour class on depreciation, but due to time, we'll move on from this because I do want to save a little time for Q&A. But I'll close out tonight's presentation by saying a phrase that I could not say enough. Who you work with matters. When you're out there making major impactful decisions, like a major medical decision, you obviously want to work with the best doctor you can access if you're having a major surgery done. And when you are making a major financial decision, the situation is the same. You need to work with the best professional you can find. Now, I find in my industry of real estate sales and brokerage, quite often we are saturated with realtors that are just not qualified. They do 1, 2, 3 deals a year. If you do 1, 2, or 3 transactions a year, you're probably not going to be that good at what you're doing. On our team, we focus on being full-time professional realtors. We educate our clients. So rather than working with someone because they're your friend, rather than working with someone because they're your relative, you should work with someone that knows what they're doing as a professional in their business. For this reason, I would invite you that if you're interested in buying real estate or investing in real estate in the near future, feel free to reach out to my team and I at the Kappel Realty Group. You find my contact information here on the screen in front of you. Again, the best way to get a hold of me is email patrick.kappel@compass.com. And if you'd like to meet with my team and I, how does that look? We usually start out with a 60-minute introductory Zoom meeting. If you'd like to meet with myself and one of my team members by Zoom, just shoot me an email. We'll set it up on the calendar for a day and time that works for both you and me. And it's really just kind of non-invasive, 60 minutes, learn a little bit more about you, what your goals are, what you want to do in real estate. And you can also ask my team and I any questions you have about buying real estate. With that, I'll take a look at the chat to see what kind of questions we might have. I see just one question. How many times can you do a cash out refi in the same property? Is there a limit? I think I answered that one, but you can do cash out refis an unlimited amount of time, put as many zeros behind it as you want. There's infinite Yeah, I've cash out refied that one property, as you can see, 3 times. So, and you could do a cash out refi property 300 times. With that, it looks like there's no other questions, and I'm right on schedule at 6:30. I look forward to hopefully working with some of you in the future. And I look forward to hopefully also seeing some of you of our next webinar, which will occur in about 2 weeks. And at that webinar, we will cover an update, deep dive on the San Diego real estate market and the national economy, how it's affecting real estate. See, a question did pop up here. Is there a company that does cost set? Yeah, there's multiple companies that do it. The name of the company I hired is not on this, but it's KBKG. KBKG is who I hired. Anyone that wants to get connected to a cost segregation study firm, let me know, shoot me an email, and I will do a warm introduction between you and the firm that I've worked with. And they're top of my mind because I just got a bill from them this month because I recently did a cost seg study. All right, guys, enjoy the rest of your evening, and I hope you got a little bit of an education tonight. We'll talk soon and hope to work with some of you in the near future. Bye.